And so where the rationale for this, because when I first heard about these things like years ago,
it feels contradictory, Bob.
Exactly. Right. I actually thought, what the heck? Why would anyone want this? Like, I thought the whole point was, and like we were saying, like the early people who were really happy about what Satoshi's white paper and getting into Bitcoin, a lot of them, you were right, Drew, were real big like libertarian types.
What are we doing?
Yeah, and so because they didn't like the U.S. dollar, they didn't like government dirty fiat money. This was this hard money that was, outside of the government's clutches. And so then to say, oh, why don't we take that technology that was invented for Bitcoin, namely blockchain-based, tokens moving around, and why don't we do something similar, like on a different chain, but instead we're going to be keeping track of things that by its very construction will be worth $1.
Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I am the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. By the way, if you're out there and you are at one of the big investment firms, and if you've always dreamed about how to become an independent advisor, we have greater flexibility and freedom. Give us a look because we may be a great fit for you. One of the nice things about what we've done is we've created a blueprint to help you move from the old firm to the new firm and do it successfully and have great success on the other side. But for a lot of people, it's very scary to make the jump. And so we've created a system to help you have as much success as humanly possible. The other downside, though, or one downside I would say to the independent space, is that you can be quite lonely and you can be on an island. We've created a great network of advisors at True North where there's camaraderie and idea sharing. So you kind of get the best of both worlds, the backing of a firm, but you're also getting the independence and flexibility of being an independent advisor. So again, if you're interested, please reach out to us at True North Wealth Management Group. Today, I had the great fortune of interviewing Bob Murphy again. So, many of you probably already know who Bob is. He has quite a great following. Bob is the chief economist for Infineo. And Bob is a former academic, has a PhD in economics from NYU, and he runs 3 different podcasts. So Bob is a dynamic thinker. He's become a friend of mine. He actually doesn't live too far from me here. He's up the street in Massachusetts. I'm in New Hampshire. So I've enjoyed getting to know Bob on the side, and then we just had a really dynamic conversation. I did make an executive decision to go ahead and split this episode up in 2 because we really got deep into the weeds with stablecoins today and with the passage of new legislation. So this first part, you're going to hear about stablecoins and about the Genius Act that was recently passed by the Trump administration. And in the second part of the interview, you're also going to hear, which will come out a week later, you're going to hear about his thoughts on AI. Okay, so this is the first part of the interview with Bob today, and we really get down into the weeds of cryptocurrencies more generally. So you're going to learn a little bit more about cryptocurrencies and what it actually means, what is Bitcoin, and then we get into the specifics of a term called stablecoins, which has been in the news a lot recently. And the reason is that there was a major piece of legislation that was passed regarding cryptocurrency and specifically regarding stablecoins called the Genius Act. So we're going to get into the implications of what does this mean for cryptocurrency more broadly, but also what does this potentially mean for the broader banking system and the financial sector over time. So I hope you enjoy this. This is a thoughtful dialogue with Bob. Hey, Bob, thanks for coming on the podcast again. It's great to see you.
Nice to see you, Drew. Glad to be here.
So we're going to talk a little bit about stablecoins today, about crypto. We're going to talk about AI. So I've been eager to dig into these topics with you because I know that you're spending a lot of your time in research in these specific areas, and you actually work in an industry now that deals directly with crypto and with AI. So I'm excited. So Bob, you've long been a defender of sound money and market-based solutions. Can you give the audience like a quick primer on like what does sound money really mean in today's digital economy?
Okay, sure. So maybe the way to answer that specific question is to first answer what did sound money mean historically.
Yeah, agreed.
And so there, and I'm drawing here, I'm a member of the so-called Austrian School of Economics, and my hero and intellectual, the person who gave me the worldview that I use the most is Ludwig von Mises. And so in his work, he championed what he called sound money. And the idea was that the citizens needed protection from the prince or the political class from debasing the currency. That was the idea. And so, and Mises said in his writings, I'm not going to get the exact wording right, but he said something like, in the classical liberal tradition, the principle of sound money is analogous to like the protection of free speech, like in the Bill of Rights or something. And he's saying, so it wasn't just an economic thing. It was more that you're providing a zone of protection, just like the government can't throw you in jail for criticizing the government. And everybody knows in a free society, that's got to be true. By the same token, in a free society, it can't be that the political officials can just take away 30% of the purchasing power of your money just by running the printing press, right? So that was the way he was saying that it was part of like limiting the power of the government to do bad things to you. And so that's what sound money meant, and that's why it was such a part of the classical liberal tradition, not just among economists, all right? But so back in those days, of course, it meant commodity money like gold or silver, and that was sound money, as opposed to government fiat currency, which isn't backed up by anything, because the primary virtue of commodity-based money, either people literally just walking around using gold and silver coins, or what eventually became to be the case that yes, there was the U.S. dollar and the French franc and the British pound and so on that were paper, but they were ultimately redeemable for a fixed amount, a fixed weight of gold and or silver, depending on the time frame you're looking at. And that kind of kept them honest, right? They couldn't print, the U.S. authorities couldn't issue too many dollars because anybody could just turn them in and get the gold for it. And so that kind of, kept it within limits. If they printed too much relative to other nations, gold would flow out of the vaults of the U.S. Authorities and into the vaults of the Bank of England or the Bank of France or whatever. All right. So that's kind of the backdrop there.
Some discipline.
So and of course that all was completely, the last vestiges of those constraints were completely eliminated in 1971 when Nixon, put the final nail in the coffin. The classical gold standard had been getting hammered ever since World War I forward. Like it never got back to the 1913 meaning of what people thought of as the classical gold standard. But Nixon in 71 completely killed that, where now the dollar wasn't tied to anything. That the U.S. authorities were saying, no, if you come in and give us a $100 bill, we'll give you 520s, but we don't owe you anything. It's not a claim on anything. It just is what it is. And it's not a coincidence that when was the worst peacetime inflation in U.S. history? Oh, it was in the 70s, right after they did that. Right.
Interesting.
So that's anyway. So that all fits, and the intuition's pretty straightforward. If the authorities can just print money, with the only constraint being if prices rise too rapidly, the public's going to get upset. They're probably going to print a lot of money, right? Okay. So with that context, then now in the age of blockchain-based digital currencies, let's say, then blockchain-based is a particular variant of that. That was part of the drive for Bitcoin originally. Like if you go and read, there was this whole subculture of people who could see the problems, the downsides of government-issued fiat money. Fiat just meaning like it's not backed by anything; it is what it is,
just
because
paper
the government
dollars
says so. Yeah,
right.
And then there were various proposals, like Friedrich Hayek, another giant in Austrian economics. He came out with a pamphlet where he had argued for, he said it's not fiat money per se that's the problem, it's government monopoly of it. And so if you had different private companies issuing like paper money,
it's a great distinction.
Electronic, claims or whatever that weren't, backed up by anything. It wasn't like, oh, this is just a ticket entitling you to an ounce of gold or something, but just that they used, if they could get it launched and the public started using those as monies, as long as it's all voluntary and private, he was arguing there was competition between these entities issuing them. He just spelled out the economics of that and what that might look like. And so his point, and different, like Murray Rothbard didn't like that, right? So I'm not saying this is what the Austrian position is.
That's
but
a
I'm
big
just saying
debate.
that this is like partly, I'm just so your audience isn't getting lost, Drew. I'm just trying to explain like the intellectual development leading up to this stuff. So Hayek wrote all that. I think that was in the 70s, in the context of just paper-based, and then, understanding that banks had electronic, they could, we had computers and stuff in terms of ledgers, entries, but there was nothing like blockchain at that point in our modern terminology. And so anyway, that the issue, people were trying to, they're called like cyberfunks, and What they were trying to come up with as technology was advancing, and and especially then once the World Wide Web comes along and everything, people they realize there's got to be some way here. But the problem that they couldn't quite solve is there still is this issue of trust. Like even in Hayek's system, and this is what some of the critics pointed out, once an institution that was issuing like private fiat money got people using it, why couldn't they just print a quadrillion of them? You know what I mean? Like, and then go buy all the stock markets in one night before anybody realizes what happened, and then say, and then you could say, oh, well, people would stop using their currency, but they already bought everything. You know what I mean? So sure. There were issues like that where there was this fundamentally, whether it was governments or private companies, people were trusting them to be responsible, and certainly with competition and whatever, that the harm would be limited if you had it private and voluntary. But still, there were those issues, and so that's what the genius behind Bitcoin was it was this way to get this decentralized ledger that nobody was in charge of, in a sense, right? So that I'm just explaining, like that's why Bitcoin was so special, because people had conceived, you could have had digital-based money before that, but ultimately you'd always be trusting, that particular, whether it's PayPal or whatever, ultimately you were trusting that institution was keeping the books honestly. And so that was always a problem. Whereas, again, with Bitcoin, the idea is no group of people, even if they wanted to, could
because it's so transparent,
right? And just the way it works, that it's basically just a giant. It's a public ledger, meaning it's just keeping track of all the Bitcoins that get quote mined into existence, and then just keeping track of who controls it, what addresses are, where are they located, in a sense, speaking metaphorically, obviously. And then the people who have the private keys have the ability to tell everybody, yes, I want to move this Bitcoin from that address over to this address over here. And
that shows up on the ledger.
Yeah, and that's why it's called blockchain, because it's just a block keeps track of all those new transactions and then gets added to the chain. So the chain just keeps growing, and you can just go back in time from when Bitcoin was launched. Right, and so that's what the ledger, and there's thousands and thousands of copies of that ledger. Anyone can download the software and go ahead and grab the latest version, and they can have it, on their system. So that's the sense in which it's decentralized. You couldn't knock out Bitcoin. It's not like there's two computers somewhere where if you went in, if the FBI raided them, you could knock out a bunch of the computers, but there's still copies all over the place. It'd be like trying to get rid of Moby Dick or something. You can't. There's too many copies of it floating around, right? Right. So that's kind of the idea. But to answer your question, there's protocols in place, and it uses a lot of math, fancy math, and so forth to how it works. But the idea is that only somebody who has the private key should be able to convince the network that, yes, I am the rightful controller of these Bitcoins, and that's why I have the authority to transfer them to somebody else. And so that's all that the ledger does, is just keep track of where these Bitcoins located, in a sense. And so if people started using that as something that was valuable, so that, here, I'm going to give you my car, but in exchange, you use your private keys to tell everybody who cares about this thing that, yes, the Bitcoins are moving from that address to this other address that I happen to be the controller of, that I'll give you my car. Like, that's basically all that's going on. It's just, people are giving valuable goods and services in exchange for moving where this ledger thinks these Bitcoins are located, when it all comes down to it. But again, the beauty is nobody is in charge of that. No one entity has to be in charge, and we got to trust their integrity. Like, it's decentralized, and it's like the system can agree, yes, that's a valid transaction.
Now, my understanding is there was an individual who created it, but we don't really know who that individual is. There's a name. What was the name of the individual? That might all be metaphorical for Bitcoin. Satoshi, right? Yeah. And my understanding is that at least the creator or creators were coming from a more Austrian free market perspective of sound money. Is that true?
I mean, so on the one hand, right, like people think that was a pseudonym and it wasn't the person, or it could have been a group's real name.
Like a John Galt kind of a figure.
Right. So on the one hand, because we don't literally know exactly who the person or persons were, we can't literally say, yes, we know by the time this person was 26, he was reading such we can't make statements like that. But that's what I'm saying, that this whole literature of leading up to Bitcoin. Like, yeah, there's a whole tradition it was drawing on, and so yeah, I think it's entirely plausible that whoever Satoshi was or group of people it may have been were influenced by those currents.
It seems like not too far of a stretch to say that they were probably or potentially influenced by sound money proponents like Mises and Hayek, Rothbard, etc. And then furthermore, it seems like the early proponents of Bitcoin, at least people that I know that have been were in on it even 10 years ago. A lot of those people were sound money types. They were excited about the idea of it, so it certainly disproportionately attracted sound money proponents that were frustrated with government fiat currencies. And
if I may,
go ahead.
Please. You're right. I went off on a tangent that I hope was interesting for your audience, but I didn't fully answer your original. I didn't answer your original question.
It was all great.
What does sound money mean? So, in the context of everything I've been saying so far, so that you're right. When Bitcoin first launched, if you go read the Bitcoin white paper, like the motivation given, it's things like basically trying to avoid ridiculously high bank fees and things like that. It was trying to come up with a low cost way to engage in payments. That's the original vision that was spelled out in the paper, besides all the technical details of how could you actually implement this and do it. And so somebody is working in the U.S. and they have family in Africa and they want to send remittances to them to go through Western Union or Chase Manhattan right now. It's crazy, especially if we're talking about small dollar amounts, how much they would slice off the
transaction
top.
Costs are very high. And this cuts down on transaction costs.
Right. So, but then the other big thing too was the trustless nature of it, so that it was this protected system. And then the way the Bitcoin protocol works is there's what's called the halvings, with HALVE. It gets cut in half. That's what that refers to.
Right.
And so the idea is periodically the amount when what are called miners validate transactions, they get awarded new Bitcoins, and that's how they come into existence, right? So the total stock of Bitcoins that are like on the blockchain, like their location is specified on the blockchain, that grows over time, but the rate of increase tapers off until eventually it reaches 21 million, and then it's just 21 million forever onwards. And then people lose their keys along the way. So in practice, 100 years from now, there'll be fewer than 21 million Bitcoins, quote, in circulation, if you want to think of it like that. And so that's why it's incredibly hard. If people adopted it as a money, it would be incredibly hard, even harder than gold and silver, right? Because again, the virtue of gold and silver is the government can't just flip a switch and create more gold. You have to go dig it up.
We could mine for it, but we can mine for it is the premise.
Right. And so, yes. And so that's the idea that, more gold will be mined. But also, too, there's proposals that, there's asteroids and stuff floating around the solar system that might have tons and tons of gold.
Sure.
And so, if we could get them, or, like in the Star Trek technology, like the Next Generation, where make me a cup of tea and it just kind of materialized. Like you could just say, make me a kilogram of gold, and it could just do it. Then gold would no longer be a useful money in that sense. Whereas with Bitcoin, it's mathematically, determined. People talk about could quantum computing break that or whatever, but in terms of right now, there is a sense in which it's mathematically limited, that they're only going to be 21 million. So that scarcity is built into it, which is a virtue when it comes to money, right? And that's a very Austrian.
That's very Murray Rothbard, to be very specific, is my understanding. And I know listeners most listeners won't even understand that, but Murray Rothbard's premise was we should have a fixed supply of money, right? And that's it. And well, correct me if I'm wrong. My understanding is that Murray did not, or Rothbard did not want any sort of additional increase in the supply of money.
Well, I mean, that may be an implication of it, but yeah, the bedrock claim was in terms of serving as the money commodity, any given stockpile or supply is adequate for those services. Just prices would adjust. So that was, so there's no, and the foil, what the point of emphasizing that was to bat down the idea that, we got to have a constantly expanding money supply,
correct,
to keep the economy growing or something. Like people, that's a very natural thing for people to think. But the Austrian
deflation's bad. Deflation's really bad is the premise,
right? By which they mean falling prices. Yeah,
correct.
And so yes, the idea is it happened under the classical gold standard. It was basically as long as the quantity mined of gold was kind of like the growth in the stock of money was roughly equal in the long run to the growth in other goods and services. And so that's why the purchasing power of the U.S. dollar, for example, was roughly the same from like 1800 to 1900. Okay, so this idea that, things always get more expensive, that's a 20th century phenomenon. Back on the classical gold standard, that wasn't the case. $100 in 1800 could buy you basically the same kind of stuff as $100 in 1900. But that's because the stockpile of gold, they were mining new gold. But yeah, under Bitcoin, so yeah, it's a very Austrian view, and this is something that I address a lot. Is that yes, it's not a knock against Bitcoin to say, oh no, it's a fixed thing, and so that would in practice limit the ability of the economy to grow. No, it's just that prices would fall year by year. If every year the amount of hamburgers went up by 3%, and there's a fixed number of Bitcoins, then the Bitcoin price of burgers would gently fall every year. That's just what that would mean, and that's fine as long as everybody knows that's coming. And that's the thing too, is it would be very predictable under Bitcoin because they know precisely how much is going to be, quote, mined, very rigorously ahead of time, so they can all make their plans accordingly.
So is Bitcoin acting as a currency, or is Bitcoin acting as a commodity?
That's a tricky question.
That's a loaded question.
Yeah, so here I'm probably going to offend some of the Bitcoin fans. I've actually, in my sort of academic work on this stuff, I've said, given the Misesian taxonomy of types of money, so he's got commodity monies, which things like gold and silver, but just in general, like if you use cattle or something like that, basically anything that had some other purpose before it was adopted as what's called a medium of exchange and then became a money, that's a commodity money. He also had this category called credit money, which is kind of a niche thing I don't think we need to worry about. And then the other one was fiat money. And the essence of fiat money was not government issued coercively. That, in terms of just the classification, he was saying, no, it's that there are some authority figure that issues it, specifies these are the characteristics that make this official versus other things. So like rectangular green pieces of paper, there's very specific but somewhat arbitrary reasons why, this is a legitimate $100 bill versus no, this is just something some guy did on his laser printer. You know what I mean? Where intrinsically there's not that much. Whereas it's, if you have an ounce of gold and someone else has an ounce of gold, you don't need to say, oh, wait a minute, was this stamped by the mint? Otherwise, This isn't really money. Like, no, back on the classical, gold was gold, and as long as it really was an ounce of gold, it didn't matter what its history was or what markings were on it. You could take a bunch of coins or jewelry or whatever, melt it down, and then restamp them in coins, and you're fine, right? So anyway, I'm just saying, with that classification, I said I think technically Bitcoin would be called a fiat money, in that if it became money, I should be clear that, remember, to be money in the Austrian view means it's got to be a medium of exchange that, at least among a certain community, is almost universally acceptable. So we can argue, I don't think Bitcoin is yet there. Like, it's definitely a valuable asset that has many money-like qualities at the moment. But
it's not quite. But it's not quite a currency, is what you're saying. At this point in time,
or money, I would say,
or money. Okay,
I'm sorry to be. It's just
no. I appreciate
people. Yeah, there's a lot of fine distinctions people make, and it's more.
Thank you.
I don't want to get yelled at by people in the comments. Yeah.
Yeah, one of my pushbacks on Bitcoin as a money, and thanks for being precise with our language because I think that's extremely important. One of my pushbacks on it being a money is part of it has to do with just the wild gyration of the value of it itself. Mm-hmm. And so there's a lack of trust that exists because if I go in to buy, say I want to buy a new car and I need, half a Bitcoin to buy a new car, the value of the Bitcoin could, literally decline by 10%. While I'm driving my old car to go get the new car. That can happen, right? It's a relatively volatile asset class. So there's characteristics to it that I think don't always fit the money bucket, because I think one of the things that makes money palatable is that there tends to be a stability in the price of the money. I know it can go down over time, or it could theoretically go up over time, but there is not as much standard deviation within that asset class. And so I think that's a challenge. And I'm not saying that Bitcoin can't eventually, or Ethereum or other cryptos can eventually take on the properties of a money, but I don't see it from a volatility standpoint. How do you feel about the standard deviation or the volatility component of it? And does that even matter?
Oh, it definitely matters. Right. So I agree with everything you said, that right now, one of the hindrances to more widespread adoption of Bitcoin is just what you said, that when you're holding it on your balance sheet, yeah, there's volatility. There's a lot of risk involved. And so it's kind of like a self-fulfilling prophecy that means more people don't want to hold it. And then that by limiting it or going the other way, I've argued that, as Bitcoin adoption grows and more people start holding it, I think you will see the volatility in the day-to-day price go down. Right. So I definitely think the volatility over the next 10 years will be lower than the volatility in Bitcoin's price over the prior 10 years. And then that's kind of like a snowball effect, that it'll be less risky to hold it. And so I think more people will, put it into their portfolio just like as a hedge. And it's another sort of paradox is that right now, I'm sure you've heard of the hodlers, HODL, which is like apparently a typo. People were trying to say hold and then they just flipped it. And so now it's become the thing that meaning a lot of people, their motto is just get some Bitcoin and just never sell ever. I don't care, if your mom needs a kidney transplant, you do not sell. Never.
Yeah.
And then, and you say, why? And you say, because in the year 2050, Bitcoin's going to be the money of planet Earth. And you say, okay, but if that is to happen in 2050, then people have to be buying things with Bitcoin, right? Well, yeah, because it's going to be the money. And so, okay, so you have to give it up in order to, you know what I mean? So there is this kind of weird thing.
It's a paradox.
It's soluble. Like I've written, I've done a lot of stuff on this idea just to show this. Like there's nothing contradictory, like in terms of how it would play out over time. But it can't be that everyone just holds it all the time and it's money. Like it's what I think happens. Just to not tease your listeners and leave them hanging is that yes, the early adopters, the people who forecast that that's going to be the case in 30 years, if they're right with all this stuff, your anticipation had to be correct. Otherwise you're distorting things. By them hodling right now and trying to get their hands on as much as possible and holding it, they're driving up the price. That might bring other people in the market, just for trying to get the gains. But then as that, adoption tapers off, like as more and more institutions hold some of it, and then you kind of reached everybody you're going to reach, well, then those, 30% annual gains are going to taper off. And then at some point, somebody who's worth $20 billion might say, I'll sell 1% of my holdings and go buy a private island for my girlfriend. You know what I mean? I'm exaggerating, trying to be funny, but
sure.
My point is at some point, even the most diehard hodlers, I think would have to admit that yes, it's okay. I'm not violating my principles if I sell some, quote, take some gains, because, what's the point of hodling if you literally never sell? And so that then it would transition. And then once people started releasing they're like stockpiling it to capture the price gains. But once those gains have been largely realized, they can start releasing it to everybody else. And then it would become like a reserve asset, or, it probably wouldn't be a day-to-day currency in terms of buying a cup of coffee, just because, even there, the transaction costs would probably be high unless they alter like what's called the block size. So, can I say one last thing? I don't want to lose the train of thought that I didn't mean to be suggesting that in our day and age now, the only thing that can be sound money is Bitcoin. There's other stuff too, like you could have digital, like you could have digital tokens on other types of blockchains that point to like a bar of gold that's stored in a Swiss vault or something. So I'm just saying there's lots of things
absolutely
like that.
No, I appreciate the distinction, and look, Bitcoin has kind of taken us by storm, and it's you can see the evolution of money over time. Again, I'm not even calling it a money, but I'll contradict myself a little bit and say you can see the evolution over time. I mean, in the Caribbean, they used to use seashells and they used beads in Africa as a type of currency, and then we got into commodities and gold being used, and you see the evolution of money over time. And is this the next evolution? And it certainly seems like it is. Last comment I'll make, and then I want to transition to the Genius Act, is as someone who manages money, I look at the way people respond to different asset classes psychologically, and the way in which people respond to Bitcoin feels a lot more like the S&P 500 or even hedge fund than it does like money, right? I mean, even the idea of the hodlers, they're paradoxically, even though they view it as a currency, just to distill your point, they're owning it the way you would own maybe an index strategy, or you'd own a basket of stocks, right? The idea is buy great investments, own it for the longer term. Nobody talks about cash that way. Nobody talks about money that way.
Right.
They may hold money for long stretches of time, but no one comes under this illusion into my office thinking, well, we'll buy a lot of money-based assets like money market, expecting significant price appreciation. They're happy to clip off some interest on top of it, and that's about it. So just the psychology around Bitcoin hasn't quite met the money phase, but maybe it will in the future. Nonetheless, let's I want to get into the Genius Act, because one of the things I've noticed with cryptocurrencies, there's been an immense amount of regulatory uncertainty and ambiguity, and we finally got the first sort of major piece of legislation around cryptocurrencies, specifically stablecoins, which we'll get into in a moment. But what's your initial take on it, Bob, on this new act that was passed recently?
So I'll try to keep my answers brief, because I know you have a lot of follow-up questions here that we can unpack things. So I definitely am glad that they did something. So for your audience who doesn't know me as well, like, I'm a radical libertarian, you would say. So in general, I don't like the government getting involved in anything regulating commerce. I wish it would all be open. But given that we do have these authorities that are doing things, and that people know, well, if I build something and the authorities decide they don't like what I did, I can go to jail, or they can tax me, or they can do all sorts of other stuff. And that wasn't just a hypothetical threat. Under the Biden administration, they were very hostile to people who were innovating in this, let's call it blockchain-based finance, to kind of have a big bucket.
Unless your name was Sam Bankman-Fried, which is true story.
Right.
And then the regulators were talking to him.
Yes. So, and I think there's obvious reasons why that, the innovation in this space threatens a lot of the established interests, and
sure,
by its very nature, it might be harder to control. And so I think, a lot of people in the Biden administration tied to them liked having control over the economy. So my point being that the Genius Act, I think, fit in with Trump's promise when he got, won re-election, to say we're going to make the United States the crypto and AI capital of the world. Like this was part of that. And just giving regulatory certainty, I think, regardless of the specifics, was a huge win. It just, sort of gave the green light to companies, people that I consult with, and it's in this space. I participate regularly on the so-called X spaces, where with people who are doing blockchain-based things, that it just sort of gave the green light that, yes, the authorities want us to be doing this, and as long as, and they're just telling us this is the way to do it legally and in compliance, right? And that's kind of what, if you're going to be sinking millions of dollars that you've raised from investors, everybody involved wants to know, is this compliant? You know what I mean? Like, we don't want to be doing something that the authorities are going to come down 2 years later and say, what are you doing? So that's in the sense of that. And it was pretty straightforward. And it's like, okay, these are the rules. Let's go ahead and start building.
I believe it was Coinbase, the CEO, and I don't remember his name. It was Coinbase or Binance. One of them, this is a couple years ago, flew down to Washington, D.C. to meet with the SEC chair at the time. And he's like, I couldn't even get a meeting. Like, here I am, the CEO of one of the largest crypto exchanges on the planet, and I'm not being hostile. All I want is a dialogue with the SEC to work collaboratively together. He's like, they wouldn't even give us they wouldn't even, this was, he was on a podcast and I was listening to him, and I was like, they wouldn't even talk to us. And so that type of ambiguity around the regulatory environment, I think, really stifled innovation at the time. And so I'm with you. I think this is a win, right?
Yeah, and there were other things too, like if people just go Google like Operation Choke Point and then Operation Choke Point 2.0, like stuff has been coming out with like FOIA requests, but also just with the new administration and people like releasing details of stuff where, this was off the top of my head. I don't want to say more because I might botch the details, but stuff like Elizabeth Warren really, had certain people on her hit list, and they were doing things behind the scenes and stuff that on the surface looked suspicious, but you didn't really know. And then now we're getting more details. So Caitlin Long is somebody who's been documenting a lot of this stuff. If people want to go look her name up, that she's been reporting on these things because she also had a run in, like, she was trying to establish a bank that, had 100% reserves on certain crypto assets and she just couldn't get approval. And it was like, what's going on? And so now it's coming out as to why. I know another guy I won't name, but he ran a pretty big scale mining operation, Bitcoin mining. So he just had warehouses with supercomputers in there that just solved math problems in order to mine Bitcoins, and he just like his normal banks. Like he had trouble just banking with regular bank, with his business checking accounts. You know what I mean? And so nobody sent him a letter or anything, but he's pretty sure that, this is just, they had various ways of just trying to chafe and limit people during the Biden years. And now it's like, hey, we're open for business. We want you to do this. It's just that changing climate is huge. But in terms of the specifics, stuff like the Genius Act, to answer your question, Drew, I think, in the grand scheme, I would take that. Yes, that I was glad they did that, certainly compared to doing nothing and just talking.
Yeah, and I want to dig in kind of a philosophical question around regulation, which I'll do at the end of this. So you're getting into it, which I appreciate, and I'm going to come back to this point. Can you give the audience just like a really quick snapshot of like what did the Genius Act actually establish? And explain stablecoins if you don't mind.
Yeah, probably. I was going to. Yeah, you anticipate. I was going to say, why don't we first explain what's a stablecoin? So a stablecoin is different from something like Bitcoin, and I'll try to just keep it high level. So the similarity is they both use blockchain technology. Okay, and but a stablecoin. It is it's a token that resides on a blockchain. It's the same type of principles that the community can validate who has the authority to move one to the other, that sort of thing. So you've still got that level of the transparency and the trustlessness of it, depending on the structure and the issuer. But the idea is that by its very nature, a stablecoin's market value is supposed to be stable relative to something else. And so the most popular examples right now are U.S. dollar stable coins, right? So the point is that if you have, one like Tether's big and USDC is another one. If you have one of those, the point is they're supposed to, their market price is supposed to be anchored towards $1 US, as opposed to Bitcoin, which is all over the place, as we've said. And so where the rationale for this, because when I first heard about these things, like
it feels contradictory, Bob.
Exactly. Right. I actually thought, what the heck? Why would anyone want this? Like I thought the whole point was, and like we were saying, like the early people who were really happy about what Satoshi's white paper and getting into Bitcoin, a lot of them, you were right, Drew, were real big like libertarian types.
What are we doing?
Yeah, and so because they didn't like the U.S. dollar, they didn't like government dirty fiat money. This was this hard money that was, outside of the government's clutches. And so then to say, oh, why don't we take that technology that was invented for Bitcoin, namely blockchain-based, tokens moving around,
right?
And why don't we do something similar, like on a different chain, but instead we're going to be keeping track of things that by its very construction will be worth $1. And so even if there's hyperinflation, then your stable coins will be worth exactly $1, and that can go buy you, a thousandth of a loaf of bread now, right? So that does seem kind of weird, but the rationale, the market demand for it is, as more and more people got big dabbling and holding portfolios in their wallets of various cryptocurrencies like Bitcoin and Ethereum and some of the other more niche ones, there'd be a lot of volatility, and so they might want to, quote, go to cash, right? So even though everybody would say, oh, we want to get to a world where everyone thinks in terms of Bitcoin, that we're not there right now. You got to pay your rent in dollar if you're in the United States. In your groceries. And so the idea was, if you had, holding a Bitcoin, let's say it went up 200%, but you didn't, you were worried, like, I want to lock in some of those gains or just take a break, that instead of having to sell it and then get US dollars wired to your conventional checking account and everything is a huge pain, instead, isn't there a way I could keep it in the crypto world, but get it over into something that's not volatile? So that was the function of stable coins, because they're the same type of thing. It's just you trade your Bitcoins to somebody else and they give you a bunch of stable coins in exchange. So you're still in that, dimension, or whatever you want to say, that plane of existence financially. But now those things have a built-in feature where they maintain their value vis-a-vis the US dollar. They have ones for the euro and stuff like that, depending where you live and what money you use in your day-to-day life.
Right.
So that's what their purpose is in terms of the economics of it.
And I guess that makes sense, because if you think about it, everything's denominated in terms of the United States dollar, right? Like you go to the store and you buy, a loaf of bread. You're not there. I mean, I've seen a little bit of this with Bitcoin, but it's still 99.9% of it is going to be this loaf of bread costs, $5 US. And everything I do in the world of investing and finance, it's never like we're wiring, 50 Bitcoin to the private equity firm for the client. It's we're wiring US dollar denominated, to that specific whatever the instrument is, a private equity, private credit, or even a mutual fund.
And I'm
right?
guessing
everything's
too, even,
denominated in dollars.
And even if you have merchants and stuff that would be willing to accept Bitcoins, like I certainly, if somebody wanted to hire me for consulting services, this happens, and they say, "Can I pay you in Bitcoin?" Sure, but it's not that I quote and say my hourly rate is this many Satoshis, which is a unit of, you know what I mean? Like, no, it's quoted, so you can give me, at the moment you send the thing over, we check what's the US dollar Bitcoin exchange rate at that moment, and then you give me that many dollars in Bitcoins, and I'm happy to do that. Yeah,
I guess I would describe it as a unit of measurement is the dollar for all assets right now, and that's just the way it is. That's the unit of measurement. So for you look at it and you're like, well, if you're going to pay me $20,000 to do this consulting gig, and it's going to come in the form of Bitcoin, I'm going to make sure that the Bitcoin's worth $20,000. That's just the way society is running at this moment, and that is subject to change, of course.
And again, and the reason is just because my bills are that way. In other words, like if I wanted to have $20,000 more of Bitcoin, I would just take $20,000 and go buy some Bitcoin. You know what I'm saying? So like on the margin right now, my Bitcoin holdings are what I want them to be. And so anyway, it's different. Like I will just take it and hold it if it's like, because I'm not planning on just some random person emailing me and wanting consulting services. So in a sense, it's like bonus that I just keep on the side. But you get what I'm saying.
100%.
So with the stable coins, then so that is what arose. And then what's interesting though is there were various. I'll just say just a tiny bit about this, and we can take this where you want, Drew. But so okay, now that you know what's the function, like that's why they're called stable coins, is they're supposed to maintain their value. They're supposed to be stable vis-a-vis some other benchmark, like the most popular case is now being the US dollar. And so, but how do they do that? It's not, and so one obvious mechanism is if you have something backing them up, which is totally different. There's nothing backing up Bitcoin. Bitcoin is not a claim on something. If you have Bitcoins, it's not that you can turn them in and get them redeemed, whereas some types of stablecoin
it's issuers, a fiat, right? I mean, I think you said that
that's
earlier
why I was calling it fiat. Yeah, whereas
and I think that's
coin,
accurate. That's just precise,
right? Whereas a stablecoin, at least depending on its nature, might not be fiat. It's like a claim, and so the ones like some of the most popular ones, they have redemption features, and so when you say, well, why would these things maintain their value to the dollar? It's because if they dip below it, like if they started trading at 95 cents. In principle, somebody, that was big could go acquire a bunch of them at 95 cents each and then go present them to the issuer at par. So the issuer stands prepared to redeem these things, like to pay you in dollars, like through conventional bank accounts and whatnot. You know what I mean? If you present to them 10,000 of their stable coins that are supposed to be pegged to a dollar, then they have to wire your bank account $10,000. It might take 3 days to hit and everything, but you see what I'm saying? So that's, and then if you think through the economics of that, so that would withdraw the stable coins from circulation, shrinking their supply, and that would tend to push up their unit price, right? So it's kind of like the classical gold standard mechanism if there's the redemption. There's another possibility where they have what's called algorithmic stable coins, and those are the ones that you remember a couple of years ago got into trouble with Terra Luna and stuff. And there the idea was, just real quickly, that might sound really nutty to people, like, well, they're not backed up by anything. They just had all these complicated schemes by which, if there were mechanisms in place such that if it is trading below par, there were ways that it would just destroy some of the stockpile, or on the vice versa. If it were trading above par, then they would have the permission, the ability, the protocol would allow them to mint more and to pull. You know what I mean? So that was kind of the way it worked. It was supposed to be like an elastic, like accordion stockpile.
Sure.
But the problem is just in practice, there were a few famous, market meltdowns where it didn't quite work. Like the thing just kept dropping like a stone, and it just, the ability to destroy it didn't quite work. And so people, kind of got burned on that. And now they went, no, I want it to be actually, there's assets that are worth dollars backing these things up. So anyway, so that's just kind of the broad outlines. And so that was the context of now the Genius Act.
Stablecoins.
Yes. So So the Genius Act, just some of its key features, it was saying, it's saying for people who want to issue stable coins to people in the United States, obviously that's the jurisdiction. So it was saying it's got to be backed up by something, and it's got to have 100% reserves, right? Because that was one of the big things is stablecoin issuers could say, oh yeah, we've got it backed up. And look, we got some mortgages. We got, you know what I mean? Like it's one thing to say you've got a pool of assets, but if it's like allowing for a bank run. Maybe I should say at this point, there's many respects in which stablecoin issuers are kind of like a bank.
Yeah.
Right. And I don't think that's economically, like there might be some other, particulars in terms of the legality, but economically that is kind of what they are, that people would give them assets and then they would give them claims that could be in principle redeemed. And sort of like if you go and put $1,000
feels like a bank
in currency into your Bank of America checking account, you're not walking around town saying, oh, Bank of America owes me $1,000 and I can buy things if the community is willing to accept claims on Bank of America as if they're the same thing as $100 bills, even though they're kind of not. And so that's kind of what stable coins became, is once they got bigger and bigger and more people started using them, they realized the convenience. Like I said, people who are in the crypto space, instead of having to go back and forth between like traditional finance and having money in a checking account with Wells Fargo, but no, you just keep it in crypto stuff, then there you would just go back. So these stablecoin issuers realized that, more and more people now are holding Tether and USDC and whatnot, and they're not presenting them to us for redemption. We have to always be prepared to do that, just so the public trusts us. But so you see how that's kind of like a regular bank, and they can get away with what's called fractional reserves.
Yep.
As long as the public trusts that, no, I can just go in and empty out my Wells Fargo account and get $1,000 in cash. I don't need to. But then Wells Fargo, knowing that, can make a lot of mortgage loans and things like that, and knowing, oh yeah, if at any given time the community showed up, we don't have enough in the vault. It's not that they're insolvent. They have assets on their books, but they're just illiquid. They might have 30-year mortgages backed up by people who think I could just show up tomorrow and take all my money out, right? So
correct.
Right. So that's what the Genius Act was coming in and saying, we don't want that. We want to give certainty. We're saying if you're issuing stable coins that are supposed to be US dollar denominated, saying this is basically entitles you to $1. Not only do you have to have enough assets backing that up at 100%, but they specified the type of assets that could qualify as reserves, and it was really particular. It was stuff like literal checking account balances with, FDIC insured banks and things like that, or it could be treasuries. But even there, it couldn't be a 10-year treasury. It had to be treasuries that had 91 days of maturity or less. Okay, so it was really short-term, very safe dollar-denominated, or it could be like money market funds that consisted of those things, right? So, but you get the point.
And we just went through the Silicon.
Yeah,
and I think in the wake of the Silicon Valley Bank failure, where they were loading up on 5 and 10-year treasury notes to be safe, they ran into a problem. So I can see the incentive behind, hey, let's make sure they're using shorter term notes, right?
Yeah. So it's ironic because this was a huge controversy, like theoretically among like libertarians, especially people from the Austrian school, about arguing about fractional reserve banking. And so everybody in this debate, in terms of my colleagues and whatnot, that we don't like central banks, right? Because that's coercive, and the central bank comes in and gets its way, through coercion. But the academic sort of theoretical question was, in a totally laissez-faire environment, would banks that offer checking accounts, what are called demand deposits, would those things tend to be close to 100% reserves, or would they be much lower, perhaps, if that's what the clientele wanted? And then, economically, is that a good thing or a bad thing, or is that stabilizing or that's the kind of stuff we would argue about. And so with the rise of stable coins in this largely unregulated environment, it was kind of a neat test case to see what's going to happen here. Like, are these stablecoin issuers, is public pressure going to demand that they keep close to 100% reserves in very liquid assets, or, could they have real estate in Dubai or something? And that's what's backing up the, when that's kind of not really. So on the one hand, like, it was with this Genius Act, I was a bit like, oh, well, now we're not going to have the test anymore because now the regulators are just imposing it. You know what I mean? Because I was on the 100% reserve camp. I thought market forces would push the stablecoin issuers to have high ratios of reserves with fairly liquid. But anyway, now we
I
don't
know
because
libertarians
it's
that on the other end of it too. In fact, I remember
yeah.
being in graduate school. I took a monetary seminar on monetary theory, and that was a big debate in the class. And there's actually relatively free market folks that did not subscribe with modern day central banking, but they thought that the market would bring about fractional reserves. And so
I used to be on that side too. I flipped. But
interesting.
So,
yeah. That's
so
a discussion for another day. I'd love to hash that out.
So
I've
I'm
gone
just saying
back and forth.
Yeah, it's ironic here that I'm saying it was funny just how much this was like right in the midst. Like it's like my academic past and my current day job selves merged into one, because the stuff like when I'm doing these X spaces, I'm explaining like the logic and the theory of free banking and blah blah. And it's like, these stablecoin issuers, they're kind of like banks digitally. So that's what I'm saying is
it became real. It wasn't just theoretical anymore.
And that's the point I was making. Is it's kind of funny that you had all these regulators and saying, "Oh, we got to impose 100% to protect the public from these wildcat stablecoin issuers," when they were imposing regulations on them that were way stricter than on the commercial banks.
Correct.
It's like, oh, so if you need to have 100% reserves in things that mature in 3 months or less, then I guess every commercial bank right now is wildly irresponsible because they're giving 30-year mortgages. What are you doing?
Welcome to the club.
So
yeah, no, it's super fascinating. So generally speaking, it seems like you have a favorable opinion to in many ways around there being some regulatory certainty. What are some of the unintended consequences to say the Genius Act in your estimation?
Okay, well, another main element of it is it prohibited the payment of interest to the end user, right? So before this act came around, like I was, like at Infineo, where we're, as you know, Drew, taking life insurance and putting it on the blockchain.
Sure.
We started thinking through, like theoretically at first, but then with the aim of down the road, we might try to launch a product like this, of having a stable coin, a USD stable coin that was backed up by life insurance cash surrender value.
Very fascinating.
Right? So, so to give an idea of people that kind of mobilize their assets and be able to effectively borrow against their policies, at a lower rate than just going to the carrier. That would, have to be true to make it make sense. But then, we were trying to think, well, okay, if we have this relatively new type of stable coin and life insurance cash value, some people know how that works, but some people don't. And we're approaching large institutional holders of other types of stable coins that are back, the Tether, the big market ones that everybody knows what they are. And I was thinking, well, how can we break into that market? And I said, we could offer them interest, like to say, so the way it would work is like, if you're holding 100 of these stable coins issued by the Acme Corporation, backed up by some novel asset, whatever it is, it's each coin still has to be worth $1. That's the whole point. But what we'll say is every year we'll give you 5 more coins if you keep your holdings of our thing. So it's like that there's interest being. It's sort of like getting interest on a checking account, right? If you keep your funds parked at Bank A versus Bank B. So that's the kind of thing. Like, you want to hold USD denominated stable coins, but you have a choice. There's competition in which particular stable coin do you want to hold it. And so I thought clearly what's going to end up happening in terms of market competition is they're going to start offering interest to their customers. Again, the unit is still trades at par. That's the whole point. But like you get more awarded to you if you hold the thing. But the Genius Act prohibited that. And they said, no, you can't. But I think, so there's like a benign explanation and then a cynical one. So the benign explanation is they wanted to just make it feasible. Like you can't insist on having 100% reserves on things that at best are T-bills. Like there's not much rate of return the stablecoin issuers can, much juice they can get out of there. So how can they pass through interest? So it's kind of like just to keep things straightforward that if we're going to insist on these high-level reserves that you can't be passing anyway, so maybe they're just trying to forestall that. The cynical explanation is I thought the major banks, like conventional banks, were involved with this whole process, and they realized, these stable coins, like there's a sense in which that's kind of like banking, online banking, and that challenges our business model.
It does.
We can't stop it. It's too big at this point. We can't. So what can we do to buy ourselves 10 years so they don't just put us out of business is let's make it that they can't pay interest to their customers, whereas we can. Right. So that's kind of, and let's insist that they keep 100% reserves in things that are like T-bills or even more liquid. So I think they kind of put a box around it. Like, here's stablecoin issuers. Here's a sandbox you can go play in and do your stuff. But you're not threatening us because you can't really compete with it. You can't be earning money on the back end by investing in longer term assets with a higher rate of return. You can really only take your customers' funds and put them into T-bills or checking accounts. And you can't pay interest to your clients, right? So I think they kind of locked in the ability of that to penetrate and to really compete against online checking.
So one of the things I've been thinking about, and I have a couple just other quick questions. I do want to transition to AI with you as well. But one has to wonder, will traditional banks start to see the writing on the wall that they need to implement this technology? So it's like adapt or die. Do you think there's the potential that major institutions, like the major commercial banks that borrow from the Fed, do you think you could see a major change in that landscape where they know, like, hey, we're going to have to start to play ball in this crypto space or stablecoin space, or we are going to be, sent packing, especially around the transactional cost piece, because this is providing an immense amount of competition because it's so much cheaper to transact through crypto than it is through the traditional banking system. So do you see a future where the banks are going to really change, or could it lead to their extinction one day, looking 5, 10, or further years down the road?
It's a little both. I'm being a good economist here. I'm just trying to be wishy-washy and give you all answers.
Yeah, I'm sorry. I'm asking you to peek into the future and let me know exactly what happens, because you are Gandalf, by the way.
Yes. Thank you. So, so you already do see the big players are getting into this space. Various they're offering ETFs of Bitcoin and things like that. So this is becoming much more of a standard thing that the major financial institutions are getting divisions, at least, that are in blockchain based finance, right? And so again, I think it's just because there's going to be a snowball effect where right now it's still the case that like asset managers might literally be prohibited from having an allocation to Bitcoin. Whereas I think 5 years
I can't recommend it. By the way, I cannot recommend it regulatorily. Like it's
right. So I think,
but that's going to change,
right? Because, and not just because of cronyism or something, but because the fundamentals I think will change. Like we said, like in 5 years from now, instead of it being like, oh yeah, Bitcoin might go up 80%, but it also might go down 30% next Tuesday. Yeah, as an institution, you're managing a pension, you can't have 30% in that. That's crazy. But
correct.
As the volatility comes way down and it just becomes more of a hedge, and it's kind of like, it'll be more like gold, right? That I think as Bitcoin starts to operate and behave more like gold, it's just more convenient to move around and stuff.
Sure. Then
I think that, because you don't have to store it and things like that. I think that problem will largely solve itself, and those covenants will be relaxed and charters and so forth, and more people will be allowed to have exposure to it. So, in one sense, the major financial institutions already are adapting in the sense that they've got people on their staff who are into digital finance and whatnot and alternative asset classes, and they're saying, guys, this is the wave of the future. We got to get into this. So you do see that in terms of just still their basic business model of how much do you have in your Bank of America checking account? Ultimately depends what their computers say. Like they're keeping track of that. You can dispute it and they have mechanism, but ultimately, they are in charge of telling you how much they owe you. Whereas again, with true decentralized blockchain, that's not the case. Nobody is in charge of it. And so I don't in a sense, to fully transition to that, they would be putting themselves out of business, at least if what you mean is their old way of doing business.
Yeah. Yeah, I think a lot is going to change for sure. Quick question. Secretary Scott Benson said that there will be a greater demand for treasuries as a byproduct of this act, and just with greater regulatory certainty around what stablecoins are. Do you agree with that statement? And why do you think he's making that argument?
Oh, I absolutely agree with it. And in fact, that's again part of the benign versus cynicism. That. Just think about what we said, that before. I thought, had it been left unregulated, like in the probably the perfect world, certainly they would have said, so long as you don't violate contracts with people, and so long as you don't lie to them or whatever, then
that's never going to happen.
Right. Then go do what you want.
Yeah, but that doesn't happen.
Right. So that wouldn't have been it. But compared to that benchmark or that regulatory regime, again, I think what you would have seen is some stablecoin issuers would have operated on the scale of, hey, you wire us funds, like you give us conventional dollars somehow, then we go and buy assets with that, and then we issue you stable coins, that are our tokens on the blockchain that we run and whatever, and then we just we pledge that we're going to keep it, and if you want to redeem your stuff, you can, and we can be in riskier, longer term assets that have a higher rate of return. In exchange, we'll pass some of that earning on to you and share it with you, the customer, right? So that's kind of like, if you want to have a checking account that pays interest, the bank can't keep your currency in the vault 100% because how are they going to pay you interest? They need to go lend it out to people, right? So that's the spectrum of the risk reward for the client. And I'm saying in that environment, then the stablecoin issuers who were operating on the riskier end, what allows for the payment of interest, they wouldn't be buying treasuries. They certainly wouldn't be buying T-bills because there's no yield there, right? They would be buying other stuff. So I'm saying here, what the Genius Act does is it insists this entire space, if it grows to, as more and more people want stable coins, is that to the extent that grows for that, there's people want that, they want to hold those because it's more convenient than other types of dollar-based assets, then there has to be a one-to-one demand somewhere else. Somebody's holding treasuries to back those things up. So they've just automatically built in, like if you think the growth of USD-based denominated, stable coins is going to grow by 5 trillion over the next 10 years, you just guarantee that there's going to be 5 trillion extra in demand to hold treasuries because someone needs to be holding those. So that's what I'm saying. Yeah, they built that right in.
Which may further entrench the United States dollar as the world's reserve currency as well. You can kind of see a lot of downstream effects from this.
Yeah, but just to be clear, those are two separate. I think they're both true, but just those are two separate claims. So the one is they're building in demand for treasuries.
Yeah,
and then the other is they're fostering the continued dominance of the U.S. dollar as being like the medium of account that people have in their heads when they're doing global transactions.
Okay, good point. A good point.
And I think it does both because it's making it now as more people issue stable coins, it's just going to become more commonplace. You know what I mean? As more and more people are using stable USD denominated stable coins or pegged stable coins, it's just going to be the thing to do. And so, yeah, I think that is going to further just people are going to use that's going to sweep the globe, as opposed to a euro based stable coin or even like a gold based stable coin, I'm thinking. And so, yeah, that will help them get their foot in the door for people as more and more people move into blockchain-based finance. If the biggest game in town is Tether or USDC or whatever, that's, I think, just going to lock in first mover advantage. More people are still going to be thinking in terms of dollars.
Okay. So I do eventually want to get to AI, but I have one other comment for you.
Yeah.
And on time, if I take another 20 minutes, is that okay? Or do you have a hard stop, Bob? Okay, great. I appreciate it because I really want to talk to you about AI. One comment that I had was I've thought a lot because I definitely fit within the free market camp, but spending, and I don't know, Bob, if it's just hitting middle age and becoming a little more practical about life and you spend a little bit less time kind of in the academic space or in the ivory tower. But I used to spend so much energy kind of pushing against all types of regulation. And fundamentally in the ideals, I call it the world of forms if you want. Yes, in the perfect space, society functions well and we're not needing regulation. There isn't the state to have to force it. But the reality is there is a state. The state isn't going anywhere anytime soon. We have to live in practical reality. And I oftentimes see these debates where people push back against all types of regulation because they feel like they're sort of caving or they're acting like a heretic and they're not being true to their ideals. But that's where I think sometimes life becomes super paradoxical, where it's like, yeah, in theory, I would love a free market banking system. I think it would be better and healthier. But the reality is that we operate in the real space right now today. I work in the financial markets. And sometimes there's so much damage with no regulation or no certainty. And you touched on this at the beginning. And I guess my thought on this is, are there moments, even for someone who's quite libertarian like yourself, are there moments where you're like, hey, look, in the ideal, we don't want regulation. But we also are living with true constraints, and a little bit of certainty around regulation certainly trumps just absolute ambiguity that existed with cryptocurrency. And you kind of touched on this, but how do you feel about those statements of maybe as free market folks leaning a little bit more towards practicality? It doesn't mean you're sacrificing your ideals. It just means you're trying to operate in real time and space.
Yes, 100% to those sentiments. And I think partly too that, when you're younger, like my 20-year-old self, might look at my current self and think like, oh, you're a sellout or something. I don't know.
Right.
But certainly he'd be wondering like, how'd you put on so much weight? But, but I do. But on the other hand, I think part of what happened is my 20-year-old self just thought, oh, it's just a matter. People don't see it the way I do, and if I could just explain it to them, then the older you get, you realize like some people maybe just aren't that bright, but also B, I think there's a lot of people that there's this phrase willful ignorance that when I was younger I didn't understand. And it's like, why would you be willfully ignorant? I can understand being ignorant, but why would you on purpose? And then I realized, no, there's plenty of people right now that they know this is what I want the answer to be, and they just come up with arguments after the fact. You can knock down that argument, and they'll switch to a different argument. It doesn't, it's called what's called moving the goalposts, in online arguments. So just the more you see that, you just realize that, that you got to take your, partial victories and always compare stuff to, yes, you can have your perfect benchmark. This is how things would operate in a perfect world. That's not going to happen. So in a sense, it's kind of silly if something comes along that's a huge improvement over the status quo and you object to that and make that not happen because you're holding up something else. I would say you don't want to make the perfect the enemy of the good, except usually when people say that, it's because they're pushing something that I think is awful. So I don't want to say, like usually that's a thing for like, here, take this horrible thing because so anyway, that's my long
spirit of Voltaire when he said that was truly like, don't make the perfect the enemy of good, because then you get nowhere.
Yeah. So that's the sense in which, when people ask me about the genius egg, and you just saw how I have like lots of cynicism involved in where I think but
you were nuanced. But
still, I start at the beginning by saying, yes, if it was nothing or this, I'm glad they did this. I would take this in a heartbeat over nothing.
100%. I appreciate that.
Could I have written a better bill that I was? Sure. And my 20-year-old self was like, what are you writing bills for? No, you just got to say, no, people used to say, what would you do if you were Fed chair? And my answer was, I would resign, right? Because that's the pure thing to do. But on the other hand, does that mean if the Fed, tomorrow wanted to tie the dollar to, molybdenum, that would be a good idea? Well, maybe not. Gold, that's a much better idea, right? So you see that, I can sit there and comment on better and worse ways for the government to do things, even though I wish the government would decentralize and say, you know what, our mistake, why don't you guys figure it out voluntarily?
The irony is that oftentimes people that maybe hold really good, truthful principles abdicate from all institutions because all institutions are bad, and literally the world drifts in the opposite direction of where they want it to go, and that's the rub. And I'm just willing to engage the system in a pragmatic way of saying, hey, can we incrementally make money sounder? Like, let's do it. And by purely abdicating from all institutional structures, what they're actually doing is waving the white flag and allowing the system to further devalue and move our currencies to a worse place. And so I don't want to play that game. I'd rather us be engaged. And listen, it's politics, and politics is truly the art of the compromise to an extent. So let's talk about AI.
Just real quick, another example of that whole phenomenon was like with the tariffs, right? So, I would not let Donald Trump teach a homeschooling class on international trade. He doesn't know what he's talking about. He starts talking about trades. However, I've seen some of the knee-jerk libertarian, reactions to proposals for tariffs, and they're saying things that are demonstrably false. And so that's why I was trying to be more nuanced and say, look, if they could slash spending 90% and have tariffs phase out income taxes, I would take that in a heartbeat and then go through it and everything. So as opposed to just, well, no, tariffs or taxes are bad. It's like, well, they're going to tax us. And so the question is, is there a way? Yeah. And so given that there's momentum and a lot of people are on board, can I offer commentary and try to steer them and show them at the beginning, I'm not your enemy. I just want you to think through what you're doing. And what if you did it this way? That kind of stuff.
Yeah. And there's always a multiplicity of factors that, and we tend to be very myopic when we're addressing public policy. of like, well, if we just adjust this one dial, then it's going to lead to this terrible outcome, not realizing like, no, there's like a downstream cascading effect, and there's a multiplicity of factors that are driving the situation itself. And so we've got to consider all the different angles to this dynamic so that we actually come to the proper policy course. So yeah, very interesting. All right.
I'm sorry. I know you want one last just comment on
as long as you're willing to stay on, Bob. I just really want to talk to you about AI.
Another element of all that is like with all the recent stuff about Lutnick and whatever, and they're talking about like, all the stakes the U.S. government's going to take in these companies. And I'm against that stuff too. And I was making jokes on social media about, MAGA's against Mamdani having New York City-owned grocery stores, but they're fine with the federal government buying shares of Intel, that kind of stuff.
Right.
So I get all that. But on the other hand, in the grand scheme, I would rather a bunch of business titans who are very, blockchain and hard money friendly types be advising the government rather than people who are outright socialists who hate private business. You know what I mean? If I had to pick. And so, yes, I will sit there and I will point out problems and absurdities, but in the grand scheme, I'm definitely glad that Trump won as opposed to Kamala Harris, for example. So,
yeah, and look, like a David Sachs in the administration is probably a huge, advantage to crypto, for instance, because I know he's one of the major players behind it. So, here. If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com, or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.